Hey everyone, Gary here. Hey, I have an extremely important message for you guys today for this month's video. And so I skipped my lunch to bring you this message. This is how important this is. So let me jump right in. I'm going to share my screen with you because I need to keep this as short as possible, but extremely important. So share my screen with you. This is a strategy that could save you or someone that you know hundreds of thousands of dollars over the next 5 years if you qualify. This is not a one-size-fits-all strategy, but chances are, I can almost guarantee you or someone that you know could benefit from what I'm about to share with you here. So this idea is marry the house, but date the rate. So Stacy and I have been married for 30 years. We know marriage is a long-term commitment. Buying a house, long-term commitment. Okay, but dating, it may be a long-term commitment. It doesn't have to be. So that's the beauty of that. In this scenario, where I take that analogy, is you're buying the house and you're buying it at a discounted price. Right now, prices are discounted. And I'll talk about that in just a few minutes. But the idea is refinance because the market sees these interest rate hikes as short term. And I'm going to show you why. So I look at instrument panels. I'm not a pilot, but I always admire pilots. They're sitting in the cockpit. This is a life or death situation when you're up in the air, and they have to look at indicators. So your finances are not life or death, but they're really important. So we want to use the best indicators that we have. So I have a Fannie Mae forecast. I have a Morningstar, the investment service. They've been around for decades. I have a forecast from them. And then I have hey, follow the money. So my Fannie Mae forecast, they're forecasting rates, 30-year rates, below 4.5% next year. Now, this came out in August 30th. We have seen a couple more rate hikes. We've seen CPI, consumer price indexes, that have kind of gone sideways instead of dropping the way they had been expected. But we still see rates around 5 by this time next year. So, and then go ahead and use these, Google, because you guys can go to these forecasts and you can check this out for those of you who are half as analytical as I am. The next one I want to show you is the Morningstar report. U.S. Federal Reserve, it's expected to pivot to ease monetary policy in 2023 as inflation falls and the need to shore up economic growth becomes paramount. You guys can read this study here too. Just pause your video, pop this into your browser, and you can read all about that. But the next one is just follow the money. So here's what's interesting is over the last 3 to 5 weeks, we've seen that lenders are charging significant points on their loan. And what that means is they're charging money up front because they know that they're probably not going to have these loans for long term. So they started out on ARMs, adjustable rate mortgages, and now they're charging points for fixed loans. Here's a lender's educated forecast. We're going to own this loan for probably 12 to 24 months. Then the loan's going to get refinanced. We've got to make some money on it. So they're charging points in order to make some of their money because they're not going to have long-term be charging long-term interest on that loan because they won't own it very long. So what's the advantages of buying a home when there's not so much competition? So you don't have the competition that we saw for the last 8 years, minus a break in 2018 and early 19 where the market settled down. By the way, did you miss that opportunity? Just wondering. But here, you're not going to have to release your earnest money at the beginning of a transaction in most cases right now. This is the winds of the market. You don't have to promise to pay the difference if the appraisal comes in low to the seller. I mean, how many times have we been doing that? You get to perform your due diligence before and after you go into contract with the seller. That's a good thing. Sorry guys, my phone keeps ringing and I'm shutting it down. You have more than 15 minutes in the house. I can't believe how many times I saw where we could only have 15 minutes in the house, and then we had to make a decision over the last few years, especially since 2020. I remember one particular case where I'm showing a house in Lakemont, and this is during COVID. Open houses just started again. However, could only have one couple in the house at a time. And so we're in Lakemont, we get there early, and when we come out, there is a line down the driveway of over 20 parties who are standing 6 feet apart, waiting to get into the house. Just a mosh pit. So we don't have that right now. So I wanted to show you, a lot of people have asked me, where do you think prices are going to go? We have a pretty deep think tank at Windermere. I'm really proud of that because as you know, I'm a really analytical person, and I like to give people correct information that is based off of good, sound, logical study. So at the beginning of April, we put together this kind of correction model. And this correction model was, and this was before the CPI index kept coming in higher. Oh my word, the Fed is pulling on the interest rate lever, and it's still not affecting the CPI index. Now we're starting to see the CPI index go sideways. We'll start to see it falling here. But this was an early on forecast, and it was a pretty solid forecast because we thought we'd either go down 10% in terms of price. And this was a model that was based on what happened in 2018 and 2019 when interest rates went from 4 to 5%. And the bottom here is we thought, okay, well, maybe we'll go back a year in time in pricing. And here we are. We peaked out up here in April, and then we came down, and now we're kind of going sideways in this 135 median price territory. So now what's the next instrument panel that I have to look at? I'm looking at sales. I'm looking at the number of sales. Now these are East Side numbers, and these will correlate really well with the Seattle market. I'm just trying to keep this video as short as I can for you. So I would expect number of sales to be way down, and they're not. So they're following along in this kind of sideways annual cyclical pattern. So what's the next indicator that I'm looking at? The number of listings, our inventory, the number of homes that come onto the market. And I'm seeing, I mean, the number of listings should be far above 2018 and 2019 number of listings. But there's two things, just as a quick parenthetical, there's two reasons why. We stopped our building in 2020 because of COVID, and we already had a deficit in homes. And then the other thing is there's a lot of folks that, hey, we refinanced at 3%, and I don't know if it's a good idea for us to put our house on the market, sell our house, and then go buy another house and pay 6.5%. For some of them, the answer is yes. For some of them, it's no. But here's our problem. Here's our challenge right now, or the hurdle with this strategy that I'm sharing with you, is going out, buying the house, and then refinancing in 12 to 24 months. Where is my next house? I just showed you that inventory is not what we thought it might be as interest rates go up, stock market goes down, and all of these kind of negative forces are coming at us. So where's my next house? Well, with this inventory, I'm showing you this inventory in just another in just another way, looking at inventory in 2019, we hit 3 months of inventory. We haven't, I mean, we're barely at 2 right now. Why is this just not blowing up in inventory? Well, I just shared with you a couple of reasons why, but when is the right time to buy on an annual kind of cyclical basis? And this is my last data slide here. So we did a 10-year study on how many homes on average sell. So we took this number and we divided it by 12. And then we put a percentage of the monthly average on each month. So if we average 780 homes a month, right here, October is an average month. But look what happens in November and December and January and February. We have less inventory. What does that mean? We have less choices. And oftentimes the homes that we find that are listed, they're freezer burnt, they're stale, they're tattered homes that have either started out overpriced and now they're starting to do price reductions. Their condition is not so great. And for flippers, this is great. People who are home flippers, this is the time for them to pick up some of their inventory and fix those homes up so that they can get into the spring market. But for those of us that we have families and we're thinking about making a move, whether we're going to upscale or downscale, not a good time necessarily to buy houses. There's some exceptions there, and we can talk about that. But right now, if you want to avoid the mosh pit that we expect is probably going to come back in some form, I don't think it's going to come back in the severity that we saw in 2021 and early 2022 this year at that pace. But if you want to avoid having to release your earnest money at the beginning of the transaction or paying the difference when the appraisal comes in low, or you want time to perform your due diligence, or you want more than 15, maybe 30 minutes in a home to make a really big decision, now's the time. So that's my video. Those of you who know me, you're my clients, please reach out if this happens to be a scenario that you are considering or someone that you know. Please reach out and we can chat about it. And I will so shoot straight with you. You guys all know that's true. If you found me on the internet, you can reach out to me at GaryNims.com. And I'm happy to chat with you there. Thanks for watching. You guys take care. Have a great day.